Welcome to Mercury Partners Academy tutorial number 4, how we look at analyze stock analysis. I'm Marcello Zanardo, CEO and founder of MPA. This tutorial is intended for internship students coming and joining our financial team. And we have developed the investment process together with the portfolio managers. They're based in London, Mr. Alexi Kapkin and Mr. Stefano Nora, and with me, and also the help of some top financial firms. We have set up the investment process. And this is how we train our financial analysts to look at stocks. In terms of table of contents, we will describe the investment process we have set up. We will look at some correlation among MSCI factors. We will describe the Fantastic Four, and we will give you an example on a single stock, Micron Technology, and we'll look at financial ratio. But the purpose here is for you to have an idea and to be prepared before you join the internship on how we look at stocks and what you're supposed to do. Of course, like we say, you go into mercurypartners.net. Under our financial education, you'll find the tutorials there, and you can write to us at academy@mercurypartners.net. So let's start with the investment process. We're talking about equity. So these are the class. What we have done with the team, we look at the index, MSCI All Country World Index, 2,300 stocks roughly. Sometimes we will look also at the ESG 1,300. And then we have developed a quantitative screening system that will bring us down to 150 stocks. We got down to roughly 100. And then we will look with at these 100 companies, and with an active qualitative input by myself and the team, we create the investment portfolio, which is in the region of 60 stocks. We had to define the investment process. So what we did first, together with also the help of some top financial firms, we looked at the market on different factors like value, growth, momentum, quality, minimum volatility over time. And some factors like value and growth are almost perfectly inversely correlated. One goes up or outperform, the other tends to underperform. Quality is negative correlated with market and value. High dividend yield is positive correlated with minimum volatility and others. So we looked over time how the different factors have behaved. And what we come out with, we have decided to rank our universe of stocks mainly by looking at three factors, which are value, growth, and quality. And then we also looked at momentum. For each of these factors, we use some ratios. So for value, we rank stocks based on the most common value ratio, price to sales, PE, price to book, and dividend yield. For growth, we look at revenue in the previous 3 years and the consensus for the next 3 years. Also the same for EPS and book value per share. Quality, we look at companies which are considered high quality, looking at profitability like ROE, return on equity, ROA, return on asset, profit margins, and asset to equity. And once we rank our stocks based on those three factors, we also add momentum. Momentum will look at the EPS change and the share price change in the last 3 months. It is interesting that in the long term, quality companies grow faster than peers, and clearly finding quality companies, an attractive valuation, a positive momentum creates the perfect combination. This is just an example. This is not trading indications, just done as an example for financial education purposes. So clearly, we're not intending here to give any financial advice. This is for disclosure purposes. So if you become one of our junior financial analysts, in this case, we used a stock called Micron Technology. You start from an overview. So Micron provides exposure to secular trends in data centers, AI, and IoT. Memory business is cyclical, but we look at fundamentals and we ask the team to study whether these fundamentals will remain solid in the main term. Management is focused to improve the profitability of the company through acquisitions, sales of non-core assets, and cost control. And we look at basically consensus forecast and management guidance. EBITDA margin should remain above 50%, and EPS is expected to grow a double digit for the next 5 years. Then we look at valuation. Trading at 10 times forward earnings, valuation could be compelling given growth opportunities and improvement in profitability. This is an overview. So if we take a stock, you would have the name, the region, the country, developed countries, US, the GICS sector in industry. There is a specific tutorial on this. The market cap, 142 billion. The weight in the World Equity Index, 0.16, and the expected return. And in terms of expected return, we look at dividend yield plus the EPS growth, plus the PE change, and if there is an FX impact, we also consider. You will see that looking at the four different factors, so value, growth, quality, to which we have momentum, our quantitative system classifies them in quintile, so 1 to 5. For first quintile will be the best. So in terms of growth, the stocks ranks very well. In terms of value, not to the top, but second quintile. Momentum ranked third at the time of our screening, and so on. And underneath, it is important that you get familiar with the ratio that we use: price to sales, PE, price to book, dividend yield, revenue, EPS, actual EPS forecast, book value per share, and then profitability, and so on. And those are the key ratios we look at when we look at the stocks. So we start with company description. Micron Technology is one of the leading semiconductor companies specializes in DRAM, non-flash memory, and NOR flash memory, which are solutions essential to building blocks for data-intensive application across a range of sectors, including data centers, smartphones, AI, automotive system, consumer electronics. We look at management guidance. They are looking for quarterly revenues to reach 10 billion by year-end 25 and gross margin to stay between 39 and 42%. And as the AI data center segments continue their rapid expansion, revenues are expected to grow double digit to 2030, and operating margin should remain above 40%. If then we looking at our investment process, we ask our team to validate what our quantitative ranking tell us, looking at the four factors we use. Value. So we ask the financial analyst, look at current valuation versus historical level, compare it with other stocks in the same sector and in the same industry. If a growth name, once we move 3 years out, are the multiples still at interesting level? And then we ask, when we compare multiple with growth versus peer, is the stock still interesting? Is the company or industry in a secular growth trend or a theme? So those are the kind of questions we ask. And you as a financial analyst have to say, yes, the ranking is confirmed. It is still an interesting stock also on value. On growth, can we confirm that sustainable revenues growth in the coming years? Are they growing more than 15-20%? Are revenues growing faster than cost? Have they grown in the past? Look at top line and bottom line. And they aim to do the same in the future. Is the growth coming from only operating margin improvement? Is the growth in EPS coming mainly from share buyback? So all the kind of questions aim at justifying and trying to understand the future growth prospect. When we look at quality, does the company have a strong moat? We will explain what this is. Do they have high and sustainable ROE, return on invested capital, return on assets? Is a capital intensive business, CapEx revenue? So those are the kind of questions. And then momentum. What are the technical indicators like RSI? Has the company outperformed the market in the last year or 3 months? What's the share buyback program? And you, as a financial analyst, have to validate all the factors we look at and come with an analysis, some answer. This is just an example, yes or no. The company shows lower multiples compared to the tech sector. However, the cyclical business, the absent economic mode make us more wary. While the data suggests it may be positioned favorably within an industry, when we compare against a close peer, its value is slightly less attractive. So this is just an example, yes or no. And then in terms of growth, the company benefits from the growing long-term demand for high-performance RAM and so on. So these are just examples to address some of our questions below before. Also, if we decided to back a stock, we want to look at the risks, and we always look at risk. So we start with the industry. Is the industry going through major changes, new technology coming, new regulation, geopolitics, changes in macro, cyclicality of the industry? Then we look at the company. Are there any competitors which might be disruptive, might take a business from the company or even put the company out of business? Are we facing a Nokia BlackBerry moment? Is there a new regulation? Is there litigation risk? What about ESG risk? Are there any management mistakes in the past? Profit warnings? Has management been involved in actions which have hinted at reputation and so on? And then any other risk which is not captured at the industry level, geopolitical, macro? Is there a high short interest in the company? Are the forecasts too optimistic? So we try to look at our investment thesis, looking at any potential risk affecting it. And then, of course, like before, provide the downside risk of the thesis and just give your analysis. Is there a high, low, medium industry risk, company risk, and other? So we try really to analyze the investment thesis from any possible angle we look at. We look at previous estimate, we look at actual numbers, and then we look at consensus numbers. For instance, exceptionally high growth in 2025 due to new product demand, accelerating phase of the cycle with revenue stronger than normal and historical level, long-term growth ratio stabilize a mid to high single digit, strong consistent margin forecast for midterm, low level of debt. We go back in history, we look at the evolution, we try to understand in which phase the company is, in which industry the company is, will there be a peak and then a stabilization? So forecasts and actual are important, and it is your job as a financial analyst to try to understand where we're at. Also looking at report, reading report, looking at articles, and so on. We use Coifin as our platform, and we have set up different templates on the value side, price equity, price to book, dividend yield, on growth, on quality. So everything is set up in our team, but it will be your job to understand what this means and to investigate further. And then, of course, as I said, it is essential that you come on board knowing what the key ratios are. Price earnings, forward-looking, usually 12 months, which is a way to compare a company share price with its earning per share, price to book, price to sales, dividend yield, and other ratios such as EPS, earning per share, dividend per share, book value per share. And then profitability margin, gross profit margins, the shareholder equity ratio, return on invested capital, ROA, ROE. So you need to be familiar with what this means, because those are ratios you need to look at and compare at the industry level, at the peers level, and so on. And then it's very important when we also look at moats, at the business in itself. What are the competitive advantages that protect a business from competition and substitution, ensuring sustainable profit? These can make many forms and are essential for long-term investing. For example, irreplaceable physical assets like airports, toll roads, railroads, telecom towers. If you operate in this business, to enter this business, you must have these physical assets. So not everybody can come in and fill your space. Intellectual properties, aircraft engines, complex high-tech products that are hard to replicate, install base, scale. Larger companies outcompete smaller due to efficiency, network effects, Visa, Meta, stock exchange like Deutsche Börse, brand power. Look at Apple. How can Apple sell their products at a much higher margins versus other mobile phones? Regulatory modes, example, rating agencies, essential, semi-regulated, they're hard to replace, or essential services. And then we look at the risk to modes, as we said, regulation. Strong modes may attract regulatory scrutiny. Disruption and substitution, technology and innovation can erode mode, Zoom versus Teams, and so on. Irrational or aggressive competition. These can drive margins and profit down. Internal mismanagement, poor leadership can destroy value in the banking sector. Opaque or leverage business models, you can have increased risk. So it is important that you understand the business model, the competitive advantages, and the risk to those. So you have a complete analysis of what we call models. So if you want to become part of our junior financial team, you have a 5 months internship with us, leading to a potential employment or with us, with Mercury Partners Academy, or with our financial ecosystem. But you will be working with top international portfolio manager and analyst, which have worked in top firms for over 25 years, London-based and internationally based. What you need to do is write to academy@mercurypartners.net and visit our website, mercurypartners.net, go into the financial education tab and follow us on our social. That's all from me, from Marcello Zanardo, CEO and founder of Mercury Partners. Looking forward to working with you. All the best.